for plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. All right, let's go ahead and go to the next page. Oh. Roy Swanson is somebody we've had in our webinar room quite a few times now. Really like Roy's no-nonsense approach, and he's going to be giving you a class that apparently a lot of people are interested in today. So, Roy, let's go ahead and get you on here.
Hi, Jeff. How are you doing?
I'm doing good. Can everybody hear Roy? I can hear him. Yeah, everybody can hear you. All right. Let me turn over the screen control for you. Frank says yes. Let me go ahead and turn over screen control, and let's get you kind of all situated that way. Change presenter. Okay. All right. You should get the little notice that you're now the presenter.
Okay. Can you see my screen, Jeff?
I can. Triangulate your trades. I got it.
Okay. So let's begin then. Thanks for that welcome, Jeff, and thanks for everyone for coming. I think we do have a good session for today. We're going to talk about using a concept we call triangulation, using 3 indicators on Metastock to create some accurate trades. Of course, I have to show the disclaimer as well as the presenter, and the disclaimer basically says that we're not brokers or certified financial planners. All the posted results are illustrations based on simulated historical trades, and past performance of this system is not indicative of future performance. This information is solely our opinion to be used for your own explorations. A little bit about me. I'm the founder of a website called steadytrader.com. Been trading about 20 years. I started when the online trading actually just started up. I guess it was the late 80s, early 90s. Actually was in talks with DLJ to work on derivatives for them because they found out I was a math geek, and but I just went on to be a consultant to various trading system providers. My partner and I have about 25 years experience, so we know the strengths and weaknesses of a lot of trading systems, and also why individual traders have trouble even with good systems, and we try to put the information out on Steady Trader that helps individuals trade smart and trade using professional disciplines and proven techniques. So today's agenda, we're going to talk about how to scan, really create accurate buy signals. And this has 3 components. One is to set the right goals. We're going to talk about setting goals based on activity, timing, and targets. How to use the right corroborating indicators, I should say, and that's where the concept of triangulation is going to come in. We're going to talk about eliminating signal drift, what I call signal drift. Any signal system, any database system is going to have drift to it. If you could press a button and run a machine to generate signals, well, I think we would all be as rich as Warren Buffett, but there is drift, and we'll talk a little bit about that. And then we're going to talk a little bit about decision theory and the decision theory that went into this system, this methodology, and why it results in making good decisions. At the end of the presentation, I'll be showing you how to get a copy of my free ebook. It's called Read This First Before You Buy Stocks. This is a book that I wrote about 1.5 years ago. Did a lot of research on the current market changes, the fundamental structural changes in the current market, and it's a good read, about 80 pages. And we really think that people do need to have new rules for the new stock market. In fact, I saw a comment by one of the top traders at Morgan the other day. He was talking about how even today, it's 2015, most people are trading like, basically like it's 1970. In the 1970s, they're still using that kind of thought processes, and it's just people have to start to wake up and see that the market has changed. So we are going to be talking about systematic trading, and I assume everyone here, if you have Metastock, you probably are into systematic trading. I just wanted to define it a little bit. I contrast it to trophy trading versus systematic trading. Trophy trading is what you read about and all the hype and all the ads, big wins. And the problem with trophy trading, all this stuff about, oh, buy this stock, it's going to go up 200% or 350%. Problem is this is all needle in a haystack. They're just not around, these giant wins, and it's high risk because when you identify what you think is going to be a big win, well, then you have to put a lot of money behind it, and the risk is high. There aren't really any tools that are going to show you a big winner. It's usually news or information or something along that line, and it's a low percentage play. It's kind of like hunting. We think systematic trading is superior because you get consistent wins. The winners are available every day. It's low risk. You use tools and you use professional discipline. You use tools like Metastock. It's a high percentage play, and it's like farming. And I think humanity discovered centuries, eons ago, that it takes farmers to run a civilization. It takes farmers to do the right things, plant the right conditions, and harvest a little bit every day. That's what builds great civilizations, not going out and bagging an occasional piece of big game. So let's set the right goals. Let's talk about the first step in this. The goals have to do with activity, how often you want to trade, and how much time you want to spend trading. You have to figure out what your time horizon is going to be in terms of your position hold times and your gain targets. And these would be things like your percent per trade, that's going to be your target when you exit, and what kind of ROI you expect to get for all your effort at this. So the problem with goals is that the market has changed, as I said at the very beginning, and goals have to be reflective of the market as it is and not as you wish it would be. So we know what the market is now. I mean, this is one whole year of the Dow. I'll tell you why I use that later. We don't use the S&P, but they're almost equivalent. And of course, the market is right now lots of short runs up and down, changing bias every couple days. We had a little correction, and it seems almost as if we're at a new set point. Not sure it's going to break out of its, might have a slightly wider range while it finds it. But the point is that this is the new market. It's been a year. We really have to trade this new market. The market most people are trading is the market as it was. There were long runs up. It was just going up, and the runs would last for days and weeks, and it was a lot simpler to trade. So the new market is short, strong cycles. It's short profit taking by the big block buyers, the institutional buyers, that they're taking the profits as soon as there's a move one way or the other, and that's not going away. And because all these institutional players are all on the same page, let's face it, they're all using the same basic computers, the same basic programs. So this short cycle thing that we see now, the market going up and down, giving and taking, it's not going away. Because again, the big volume buyers are all on the same page and using the same basic playbook with small variations. So when we look at this, we have to first decide for ourselves, what's our activity level going to be in this market? And I'm going to use an example. Some of you may have seen this before, but I take an example from the worst period of trading in our lifetimes, and that was the crash of 2008, 2009. These are 5 months, and if you were a long-term trader, if your activity level was kind of low and you were just taking long positions, well, basically we all know people who traded like that got killed, and the crash was real. But if you were a bit more active as a trader and you were in and out every week, well, you can see that there were 5 weeks were up out of 20 weeks total. The crash was tough, but it wasn't quite as bad because you could recoup some of your losses in those up weeks. Now, where it really gets interesting is that if you look at it on a daily basis, and if you decide to be an active trader and get involved on a daily basis, well, look what you see here on the worst period in our lifetimes. 41 days were up out of 105 total trading days. That's 40%. I mean, it's not that far off of a 50-50 market. all those green lines at the bottom, versus the red, almost half of the days were up. Simple trading indexes would have helped you, make gains, offset the giant losses that long-term guys are having. So the point here is that if you have an active perspective, a daily perspective on the market, I'm not saying you have to trade every day, but to be engaged, looking for trades every day, you're much more likely to survive and actually succeed in even the worst possible market conditions. Short-term traders, I like to say, what crash? I mean, it's almost non-existent. Now, the second thing I talked about in terms of goals is setting a time horizon. And we're big believers that shorter is better. This is a long-term trend. I think most of you are probably aware of it. 1960, the average hold on a position was 8 years. Last year, it was 5 days. The pros are trading, minutes to seconds, high-frequency trading. Of course, we can't do that. But the point is that holds are getting shorter and shorter and shorter. And in my mind, one of the big reasons to advocate or to use for yourself a short-term hold strategy is that you avoid corrections. If you always think of it this way, if you're always taking your money out of the market, forget about putting it in. You're short. Your holds are short. You're always taking out every day. You've always got positions you're closing. How much damage can be done in a day or two? I mean, you're always taking money out. So it's really a safeguard against the corrections, and it could be a correction as big as the one that took 3 or 4 days in August, or it could be a correction, what I call these mini corrections that happen every 2 or 3 days as the market pings back and forth. Again, the point is that getting into this active mindset of daily engagement, almost daily trading, and short-term holds, money in and out of the market constantly, it's a much better proposition in terms of protecting yourself from the downside, forgetting about the upside. Now, in terms of gain targets, once you start to realize, that you're going to take these first two methods to heart, your gain targets have to be modest and realistic. I mean, if you're only holding short positions, there's not a lot of time for a position to make a big gain. So we're talking about looking at modest gains, 1 to 5% maybe. And the nice thing about this is that they're always available. There's always gains like this available. The holds are short. They're not going to be much more than this. You don't get into fantasy trading or trophy trading, waiting for the 150% winner. And the fact is that there are really very few long run-ups anymore. I mean, they just don't exist in this market, especially the market that we've seen for the last year, which has been incredibly range-bound. Now we're going to talk about triangulation and using the 3 indicators. And as an example, we're going to use our favorite strategy, the one we have at Steady Trader. It's called the green light trading strategy. Again, it's designed, as we've been talking about, to trade through what I call these never-ending cycles of profit-taking pullbacks. So we use short, quick moves, 2-day average holds, a modest average gain per trade of 3.8%, but highly accurate signals, and that's what you get from the triangulation. So the first thing is, okay, we get to the meat of it now, and that's picking the appropriate indicators. The indicators we feel need to be based on the modern market, as we said. Let's not trade the market of the 70s. Let's not trade the market of 2 years ago. Let's trade today's market. And we need indicators that can show us short-term moves that are going to work for us in the next few days. Now, the problem with most technicals, and I don't have really any problem with any one technical per se, but most technicals trade the old market. They trade the 1970s market. Candlesticks have been around since the 18th century. Elliott wave, he developed that data on trading, that whole theory and whole formula based on data from the Civil War to the Great Depression, from the 30s, RSI, 78, Bollinger Bands, 80s. All of these very popular technicals, and really most of them come from the days when the market moved at a much slower pace and it locked into patterns of long, slow gains over time. That's why we start with RMO. if you're using Metastock, you probably know it's a big favorite at Metastock, and we love RMO mainly because it was developed roughly in the mid-2000s. It's a modern market indicator. It's one of the few that really was based on data that reflects the market since the advent of online trading and all the fundamental changes. Now, basic RMO, be that as it may, it's also kind of, you see these buy signals. Here's just a chart. Typically, it's pretty accurate, but it'll show long run-ups. And again, we're looking for much shorter positions. So we start with basic RMO, but then the first part of our triangulation is we use it in conjunction with Wilder's measurements, the ADX, the PDI, and the MDI, to tighten it up. And what happens is we get signals that look like this, and I'll just show you a few. This is one from August. Typically, we look for a run that's going to be maybe 5 days tops. 1, 2, 3, 4, 5, 6. This one's 6. We get in here. By the second day, it's up 7% after the signal, and then it flattens out. So what happens when we combine the two indicators is we get, unlike those long run-ups that you see of normal RMO, we get these tight trends. Flat, flat, flat. Basically, we get the signal, bing, 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 up. This one was up 37%. This was a China bear fund in August. Of course, that was the right thing to do in August. Here's one just from a couple weeks ago in September. And again, you can see really not too much going on here. There was a decent RMO signal here, but then this was the one that we caught using RMO and the Wilder equations. And we had a nice tight trend of a few days. We get in and get out 17%. So this is sort of the advantage that we feel in this type of methodology for using RMO with the Wilder. Now the final triangulation we use RMO, we use Wilder's short-term trending, we use order book buying pressure, or as Metastock calls it, the on-balance indicator. We overlay that. This is the third component of the triangulation. And what we do is we use it to corroborate. Once we have a signal, and here again is the same one we just looked at, we make sure that the on-balance, the buying pressure, and this is basically, I'm summarizing, but it's basically your order book pressure. It's what's on the books at the end of the day. And if the buying pressure is up, which we want to see, that corroborates the signal. What you don't want to see is the buying pressure here going down. But typically you'll see if the buying pressure is up, the stock's moving up. As soon as it goes down, you see it flattens off here. You'll see it goes down here and the stock goes down. It's a pretty good leading indicator, and it definitely works in tandem with the other two to corroborate the strength of the signal and basically prevent you from getting into a situation that might not trigger the way you want it to. So those are the three indicators, RMO, Wilder, and the on-balance. Now, why does this work? I'll just give you a little bit of decision theory here. And the basic premise, one of the basic premises in best practices decision theory is when you have a big decision, you break it up into multiple small decisions. And you can see here we're using three indicators, so there's multiple decisions going on. Of course, we think it's a big decision to make any trade because your money's at stake. So we break it up into these multiple decisions using the three indicators. There's a law that's known as the law of compensating errors, which means that even if you make multiple decisions in one decision, you may get one or two wrong, you may get three or four right. The point is that the errors will compensate and you can't get too far into a bad decision. Now, it's more than just using multiple inputs for decision making though. We also believe that there has to be what we call a triage process, borrowing from the medical profession. Prioritizing the decisions, doing them in a sequential order and using selective filtering. And this next slide really basically is the meat of the whole process of why the green light example with the triangulation works. We start with RMO, okay? RMO is kind of what I call a medium-term indicator. It's binary, it's kind of up and down. You get the buy signal, you get the sell signal, but that's it. It's pretty much cut and dried, and it's a pretty complex formula. We pair that up with Wilder, and we do the settings in Wilder to make it short term, and that starts to rate the strength and the life cycle of the signal. Is it a growing trend, a weakening trend, that kind of thing, how strong it is. So you've got this. So first of all, you're tightening up your time horizon. Second of all, you're going from a binary signal to a signal that has some sort of parameters in terms of rating the strength and whether or not it's getting stronger or weaker. You've got a complex formula and a simple formula. So these indicators have different strengths, but together they corroborate. And then finally, with the order book pressure or the on-balance indicator, we're adding another set of basically valuable inputs. This is immediate. This is what's on the books. Okay, this is what the buying pressure is right now. So we're going medium, short term to immediate. It also rates the strength, so we get another rating, which is basically seen by the slope of that line, how steep it is. And as opposed to something like a formula, you know, a mathematical formula, or calculus, or whatever you want to say, this is pretty much a direct measurement. This is basically reading the order book and then putting some numbers to it. So when you put these three together, you know, and this is why the selection of multiple indicators is so important. You don't want to use the indicators that are all kind of the same thing, that all work on moving averages or whatever, and don't have different strengths, you know, individual strengths. What we have here are three indicators that each have a different perspective on the time horizon. They each give you a different type of output in the reading, and they're basically fundamentally different in terms of the sophistication or the complexity of what they're built on. And that's why, again, we feel that these three do work together, and I mean, the strategy has done extremely well this year. It's over 80% accurate. So I'll leave that up just a little bit more so people can understand this. This is an extremely important principle. Again, this is not just throwing random indicators together, but indicators that have different strengths and weaknesses. Finally, after the signals, we do one last exercise, and we need to eliminate drift. We call drift is a big price move that's caused by something other than these fundamental price pressure, chart pattern, whatever you want to call it. I mean, we're a big believer in database trading, but at the end of the day, the media is out there wreaking havoc on the stock prices. We call it drift because the media goes out there blowing strong, and they generate all kinds of price moves. All database systems are affected by drift, so we make a final determination, checking the news of the day on any signal to see if it's being skewed by the drift of the media, if there's a merger or an acquisition, or a good or bad earnings report, or a company, you know, scores a big government contract or loses a big contract. We just look for very, very important bits of news about the company to see if the media has been covering it and to see if there's any kind of drift going on. The other thing we do, and I think this is also hugely important, and this is why we showed the Dow instead of the S&P earlier, is we trade outside the storm, by and large, with this method. When you think about it, we talk about drift, we talk about the media influencing stock prices. You never know what they're going to be reporting between when you order your stock and when it executes. We avoid the spotlight. We really don't go into the S&P 500 because that's what the media is covering. So we avoid the spotlight stocks. We trade outside the S&P 500. And as I said earlier, we check the news. We look for extreme good news or bad news. So it's basically we do two things to trade outside the storm of the media, which is basically, like I say, doing a lot more harm than good for traders who are trying to trade systematically using data. What about August? I just want to give you a quick example. In August, our system that uses this triangulation, the green light system, we had the best 3 days in the year using bear ETFs, leveraged bear ETFs, and it was the best month of our year. These are just a few of the trades we hit. This type of system using these three indicators identified not just FXP, which I showed you before, but several other trades in rapid succession. These are all 2 and 3 day trades, and as you can see, these are all double-digit trades. These really stacked up. Again, with a system like this, it's going to identify and help you to actually make use of leveraged ETFs, because leveraged ETFs, a lot of talk about them. A lot of people have trouble making them work with this system because of the time horizon, because it tightens up RMO into basically a 2 or 3 day trade. This tends to be the kind of movement that you get in leveraged ETFs, and the bear funds are a great way to simplify making a good profit when the market's going down. These are the quick results. You can see the net ROI on the portfolio. August was the best month, but it's typically, we run about 7.5% a month. We've been doing much better than the S&P all year, and the win rate has been about 84%. Finally, we'll talk a little bit about money management. We've talked about the signals, we've talked about triangulation. I just want to say 2 words on money management because that's the other key to successful trading. It's basically, in my view, 50-50. If you've got these signals that are just signaling quick trades, trends that last, whatever it is, 2 to 5, maybe 6 days, you need money management plan to trade like that. We teach what we call a quick cycle portfolio, basically cycling money in and out of the money every couple of days. Again, our average now is a 1.9 day hold. So basically it's cycling parts of the portfolio in and out. And as I said before, this is a great protection for corrections, for swings in the market. Because yes, you're always putting money in, but yes, you're always taking it out. So the fact that you're always taking it out, you're always taking your gains while they exist, before they get eaten up by the next market swing, just take the money out and just add it up. It all starts to add up. And so we teach, basically, we call it a quick cycle portfolio as part of the strategy. If you are interested in looking at the strategy, we offer it with full instructions on how to run the scans and validate the signals and metastock, placing the orders and managing the portfolio. We have a scan room and we publish the signals, so we help people make sure that the way we teach it is the way you learn it. If you're new to Metastock, Metastock has an offer to give a free month on the system, on the end of day Metastock, for people who don't already have it. And I want to thank you for coming. That's the end of the presentation. If you want to find out more about the strategy, it's at steadytrader.com. Again, it's all based on this triangulation that we talked about. We've got some videos up there. If you'd like to request a video from our scan room, please send me an email. I'll flash that in a second. We basically, about once a week, we send out videos, and we'll actually show you, if it were today, we would show you yesterday's scan. We show you how we run it in Metastock, and then you'll see what happened today. So it's what you see is what you get. I can send you a copy of this presentation, and you can also get a copy of our book, Read This First. It's also available at the website. So again, if you do want to see a video of our scan room using this methodology, the green light methodology with 3 indicators used sequentially the way I described it, just send me an email to info@steadytrader.com or go to the site and sign up for one of the videos. You can do it there as well. Get your free copy of the book, or you can always, of course, call us at the number on the screen now. And that's really about it. I want to thank you all for coming. I'll be looking at the question board now for a minute. See if anybody has any questions. Just type them into that question board. I think I'll see you.